All us entrepreneurs want to do one thing typically at the end of our careers, right? And that's sell. That's the point of being in business, is to take care, do your products, services, or whatever. And then your retirement is to sell your business. Today we got Jacob Koenig on and with Woodbridge, and he's going to tell us all about this, right? A lot of you may or may not have known what M&As are or how all of those work. And today we're going to get into some of those details. Like always, if you do reach out, we might have to go to another episode and go deeper because there's a lot of moving parts to that. But without further ado, Jacob, welcome to the show, and I'm excited to get diving into M&As.
Absolutely, Stoy. Good to be here, and always happy to chat with you.
So let's first start with, how'd you get into this space, and why did you get into this space?
Sure. I mean, my career has kind of been all over the place. I started at Goldman in Asia. I was in Tokyo for 12 years, and then in Taipei for another 3, running the sales trading team out there. Look, actually, Woodbridge is a family business. My father started it in '93, so 31 years ago now. And so he and I had been speaking. The company had been growing so rapidly over that period. And frankly, from the period of the pandemic, it really has reshaped the industry and allowed a company like Woodbridge, who has a different take on how this whole M&A process can work and how to make it work better for those who are selling their companies. So it became too good to pass up. And I came over here 2.5 years ago now. And a similar kind of title, at least. I was running execution services, as it was called, at Goldman, and now we're on the execution side, the deal closing team here at Woodbridge. And there's a lot of differences, a lot of similarities between the stock brokerage world, the sales trading world, and the M&A space. But where it is similar is matching buyers and sellers, and being able to take this huge potential, relationships of who could be a match on both sides, and getting that into a place where you can actually make a decision, have an auction, and find the best partner for your company.
Absolutely. And let's dive right into it, right?
Yeah.
What are some misnomers that people have with M&A space?
Yeah. I mean, I think the first one, a lot of people who have a lot of their ego tied up in a company will come out and say, look, this is how important I am. This is what all the things that I'm doing. This is how great I am. And not enough focus on the company and how it can run without you. Because if you're selling it, eventually there's some transition here, even if you are staying on. And it does happen a lot where the owner will stay with the company for at least some period of time. But there is at least some view of when you'd be transitioning away to be able to demonstrate, look, I can take the time off from things and the company still is operating, still growing, even without my direct involvement. I'd say that's probably the biggest misconception that we have to address.
What about the cost of M&A, right? Why would I go hire a broker and deal with the whole situation?
Yeah.
Like, why would I do that when you guys are going to take 10, 20% when I could just go do it myself?
Yeah. No, I mean, I think it's 95% of the deals that we do end up with buyers who our client has never heard of before, especially in the lower middle market space. There are literally hundreds of thousands of potential buyers. When you're doing it on your own, you're also more susceptible to some of the negotiation tactics that can maybe trip you up. We like to say when you have one buyer, you have no buyers. The fact is, all the leverage is going to be on their side at a certain point, especially. And we've seen this from a lot of our clients who have come to us after trying to sell companies on their own. We got to a certain point, and then we got retraded, and then we were so sort of pot committed at that point, we weren't going to back out until finally got to a point where we had no choice. And so, trying to do it on your own, you have to be focused on running your company. If the company starts to have negative performance over the period of negotiation due diligence, those tend to be deals that don't work out.
Yeah, absolutely. And I want to go back to what you had talked about of the ego person, or in general, a business that is so keen on the owner running it, sales, whatever role it is. If it is solely on them, we run into issues, right? I mean, ultimately, I don't want to buy a business if I have to buy you and you're on your way out. Like, I know when you leave, it's going to take a hit.
Exactly.
What can you say to people who are either starting their own business or buying one in regards to that relationship and how to structure it correctly on the front end
Yeah.
Make sure the business can operate as a business, regardless if the owner is knee deep.
Yeah. I mean, obviously, choosing the right team around you is paramount. That's going to be the number one thing, and having those right people with the right responsibilities, but also having the structures and that mindset from the beginning of I'm creating a company that's built to last, that's built to continue to operate perpetually. And so, what does that require? Well, if it's things that cannot be automated by a machine, then it's things that can be taught to a person, and things that where responsibilities can be sort of separated and taken to a point where you have that team really running things, and yes, you're always going to need that visionary, at least someone who can keep everything together and keep things perpetuating, and then you can be at a point where, okay, those responsibilities too can ultimately be transferred.
What would you say? So like, okay, I understand we can maybe teach some people, we got all of that stuff, but like, how do I know when to start looking to sell?
Yeah.
Right. Obviously we'd all like to
Right.
sell yesterday at 2 to 10x, like, oh, fantastic. But like
Right.
realistically in my whole growth or my whole entrepreneur journey, when should I realistically be like looking into it, or how's that process work?
Look, there's no magic formula, but I would say this is if you try to time it where you're top ticking the market or top ticking your business, it's almost always going to result in heartbreak. I mean, the fact is, buyers can smell that. We saw, for instance, a couple of years back, we had a company in the metal space, and they were very sensitive to the price of metal. And sure, when the price of metal was high, they were doing tremendous business, and they would refuse to look at any bids that were coming in at a sort of a normalized basis from where those prices were. And we were never able to get anything going for them. And so I think the mistake that a lot of people make is waiting too long. A lot of the sellers that we speak to, people who have been running their business for many, many years, decades sometimes, and they've gotten to a point where I've grown this thing as much as I can, and I need some help. I need some fresh view to really get to that next level. And those are the ones that are going to be successful, where you still have some level of growth, even just sort of naturally, but you're looking for that big next step, where you've already started to decline and you're starting to say, I don't want to do this anymore because it's falling apart. That's a bad situation. So always be thinking about, how a buyer is going to be looking at things, which is they're going to want to buy a growing asset, an asset that they can step into your role and be able to step on the gas and keep it going.
Yeah. And a lot of that is emotions, right? I mean, I'm sure you have emotions top to bottom with all these deals. And like, ultimately, you as the business owner need to understand, and I don't ever say anymore or remove your emotion. Understand the emotion and understand what you're going to go through, so you can make the proper decision for you and your family, or legacy, whatever your end result is. Because ultimately, if you don't, that ego comes into play, right? It's my baby. It's worth more than I think it is. Whatever the situations are, those come up. What is the process of, I know it depends on industry and all these other moving parts, but can you generically speak about what an M&A process looks like with Woodbridge? Like, relatively, what would a cost look like? How long does this thing usually take? All those things that everyone's always going to ask you.
Perfect. No, I love this question, because this is also a point where I think Woodbridge is particularly differentiated, because our process is a bit more is more unique, frankly, than a lot of the players in this space. Like everyone else, we're gonna take you on as a client, and we're gonna make a SIM, a company information memorandum, make sure that we're getting all the good points around what your company is, how it makes money, how it's going to grow. We're going to add on to that, and this is where we're different. We have a video that goes along with all of our SIMs. If a picture tells 1,000 words, a video tells 1,000,000 words. And we found that that's been tremendously successful. 2 to 3 minutes, long enough to tell the story, short enough to not lose anyone's attention. It's absolutely critical. And having that education up front as well, of this is how buyers think, this is the types of things that you're going to encounter through this process. walking through some of the idiosyncrasies, networking capital and how these things are calculated, this type of stuff. So first step, get all the materials prepped, get the information ready to go. Step 2, create an auction. And this is, again, where Woodbridge is unique. We don't just go to our Rolodex and talk to the people we think are going to be the best buyers. We recognize the fact that, again, in this space, it's fragmented. There's literally hundreds of thousands of potential buyers. We have to go as broad as possible. And we have a teaser that's sent out, not enough information for anyone to know who you are or what it is that we're representing, but enough to get people interested to say, okay, I'm willing to sign a non-disclosure agreement, an NDA, get the book and learn more. And so where I think the average advisor out there would probably get you 20, 30 books out and think that they're doing pretty good, we get hundreds, 400, 500 sometimes books out. And so, yes, that results in a ton of interest, a ton of bids that come in. And so the first step is the what we call an IOI, an indication of interest. That's where we vet and frankly, on a hot campaign, there can be 50 bids, 100 bids. We had on one recently. It was a new record for us. You're not going to meet 100 people. That no one's going to do that. No one's going to ask you to do that. So we'll vet them for you. We'll get the cream of the crop in front of you. Then there's a decision of, okay, who do we want to actually sit down and meet with? We have those management meetings with, we try to keep it to 5 to 7 groups. That's really the ideal number from that perspective. But having that data, having that full list of bids gives you an idea of, all right, this is really the market speaking. It's as much price discovery as you're going to get for an illiquid asset like your privately held company. And so that gets us then to a point where we start soliciting for LOIs, the letter of interest, which it's a non-binding document, but it does lay out the terms and the structure of a deal. Most deals that we do are not going to be 100% cash. It's not going to just be here's $5 million, go off into the sunset. There's oftentimes what we call equity rolls, a percentage of the company that you would hold on to, 10, 20%, kind of the normal range, up to 40% we've seen. There's earnouts, there's different structures like that where, okay, we'll buy the company for $5 million up front, and then we get another $1 million if you grow by 10%, and another $1 million if you grow another 10% the year following. Things like that. And also seller notes, seller financing, where you can step in as kind of the bank, where you're getting interest payments on debt that they owe to you. So it's at that point we're comparing those structures, comparing the LOIs, and finding you the best partner. And actually, we have one right now where it was a tremendous auction, and we had so much interest that we just kept pushing, and we got all the LOIs to the point where they're almost identical. And so the 4 best groups have almost the same economics in front of us, and now it's just a matter of who do you like the most? Who's the one who you can see actually running the company with, and putting them in the position to take over for you. And once the LOI is signed, I'm going long here, but once the LOI is signed, that's when the due diligence process starts. You're going to want to, most buyers, most of the time, are going to ask for exclusivity during that period so that you're not soliciting other buyers while they're doing their homework. Because, look, it's a privately held company. You don't have reporting standards like the New York Stock Exchange is going to have. They need to be able to dive into the numbers, understand how the accounting works, understand, what the levers that they have to pull, and also the integration work that's going to have to be done. How are we going to migrate your HR systems and get logged into your tech platforms and so on. And so all of that, usually the industry average is somewhere between, 5 and 10 months. We always try to do it in 2. 60 days is really the goal. We've had as short as 35 days, 33, I believe actually was the record. And that's really what we say is time kills deals. Once you're under diligence, you as the seller want it to move fast. The longer it goes, the more that accountants and lawyers are going to dig their teeth in and try to find things that are nonsense, but get them paid. And so putting that pressure on the buyers to keep things moving, to not delay, not allow for delay tactics. And again, so that business owners can keep running their companies, focus on keeping the numbers up so that we don't have any issues and can get you paid for the company.
As a seller, at what point in this process for you guys, and then kind of industry standard, like what do I pay for? How do I pay
Yeah.
you? What's the typical for
Right.
industry, and then you?
Yeah. Yeah, I mean, I think it does definitely depend on the advisor. We charge an upfront fee, and then we charge a fee at the end. So a percentage of the deal fee is how we get paid. That's really the majority. The upfront fee is really just to pay the costs to get the book prepared, to get the video filmed, and so on. A lot of M&A advisors do charge a monthly retainer where you have to pay each month. We think that kind of creates a perverse incentive, because then we don't want this to end, right?
Might go faster.
Yeah,
Right.
exactly. And so that's at least how we do it at Woodbridge.
Yeah, it makes sense. I mean, you're putting a lot of work in on the front end.
Right.
To even get the book going, to get all this stuff. And really at that point, they can say no and back out anyway.
Exactly.
And then you've done all this work. So that does make a lot of sense. And usually everything's a percentage of whatever
Yeah.
the sale is. So that's not abnormal.
Yep.
Very transparent with that for sure.
Absolutely.
What have you seen? I guess what's currently hot topic
Yeah.
or hot industry in terms of, and how many of these things go in cycles throughout?
Yeah. Yeah, no, it definitely is interesting. We've seen, value ranges. Again, most of the time, companies are being valued as a multiple off of EBITDA. So the earnings before interest, tax, and depreciation and amortization. So that's generally how the industry standard is to gauge the value of a company. And we definitely have seen lower multiples on industries where you'd expect to see lower multiples. Retailers, the ones that have heavy exposure to where there are not contracts, things like that, where it's just a bit sticky, a lot based on personal relationships. Those generally see a lower range of multiples. We've seen definitely an uptick in interest in like pet care and things that are sort of recession resistant, where people are going to be spending money on their makeup and their doctor's fees regardless of how the macroeconomy is working, right? So those are the industries we definitely have seen an increase in interest in the past few months. And that one that we were talking about that had 100 bids, that was in the pet care space.
Which is a whole different topic, but it's just crazy to me how well pet care does. Our neighbor owns a couple facilities here and then in Arizona. And she's like, I just can't stop growing. And I'm like, this crazy thing that's going on. Apparently pets mean more than some other. So it's
maybe a post-pandemic type of, we love our pets more and more.
Yeah. And we probably accumulated more and more.
Yeah, exactly.
Throughout that pandemic.
Yeah.
So that makes a lot of sense.
Could be.
What about the buyer side of things?
Yeah.
How do you work with buyers and create your lists and blacklists and all those things? Is it open for other outside investors to be involved?
Yeah, no, that's a great question. I mean, we specialize in selling companies. So we don't take buyers on as clients, but we do interact a lot with them, as you would imagine. So we have actually a separate team that works with the buyers to get them the information to solicit the IOIs, to get more bids. And they're solely focused on getting as many bids as possible. And then we have our closing team that I oversee, where we're really the counterparty to the buyer. And so we maintain that relationship so we don't have that conflict. A lot of the space, I think, does kind of get to a point where you're friends with the buyers. You're trying to do them a favor all the time. And they're always asking, can I get additional insight here or XYZ? But what we do learn, especially on these hot campaigns where we have 100 bids, is, okay, if you want to be considered, you have to show us your proof of funds. We don't want to get under an LOI with someone just because they have the highest bid. If you don't actually have the money to make this happen, and we're just going to be sitting around waiting for you to get enough of your buddies together who are going to add equity into this deal, that's not a good position to be in. And frankly, especially in 2023, when the banks stopped lending, we were looking at who can finance deals without going to a bank. That was a big part of it. So, I mean, the advice to buyers is be transparent, be open. Show us what you have, who you're dealing with. If you do have sponsors that are backing you, bring them in with you. Let us talk to them. That level of transparency and insight, that's going to give you a leg up. That's going to make us much more comfortable putting you in front of our clients. Because again, we want to just trust but verify.
Absolutely. Are all businesses in all industries sellable? Are there any that you're like, you just right now say, hey, this is really tough to do?
Yeah. Look, the vast majority of clients that we have, we're going to get them done. Whether it's on the first round or not is a different question. We definitely will go back to market. And what we found is when we bring companies back to market, we get a whole different set of buyers, which is really interesting. And you might not expect it, but timing is definitely a big part of it. So, don't get despondent if it doesn't work out the first time. We will find the right buyer eventually. I think the right buyer is out there for any company that's not doing anything, fraudulent or otherwise. As long as you're upstanding and you're honest, transparent, and you're running a business that's making money, we'll find you in the match. I really do believe that. It is harder when it's retail. It's definitely harder, as we said, when there's a lot of reliance on personal relationships, handshake deals. But that doesn't make it impossible. We can find a buyer who wants to step into that role and wants to be trained. It's going to mean that you're going to have to stay along with the company for a longer period of time. There might be some structure to the deal that incentivizes that. But certainly there's a way.
There's always a way. That I love that sentence. I tell people that all the time because within their own personal wealth journeys and their business wealth journeys, like they always think like, this is it. It's all I got. It's like, no, there's always a way. We can always figure out a way. It might be beneficial. It might not, but there's always going to be that way. What I was just going to ask. All right. So we figure out there is a way. There's really every industry is open. Let's hit upon something that just happened today. Now we're filming on September 18th.
Oh, yeah.
And interest rates just got cut like an hour or two ago.
Yeah.
And so I'm going to expect, I've told my clients this, that, hey, through this year, let's get through the presidential election. Deals will be had. There will be a lot of deals coming down the pipe for two reasons. One, any political and presidential election, everything's always like a hold my breath, wait and see. Although it really never matters at the end of the day, but like they always do that. Hoard cash, but also we've had high interest rates, and now we're going to see the market come back down. What can you tell people right now? And it doesn't really have to be like specific advice, but general advice with either buying or selling. Now that interest rates are coming down, now that the election will be coming soon, what do you expect the next, last quarter of 24 and then beginning of 25 to kind of start to look like for deals?
Yeah, no, I definitely think this is going to help the market. No question about it, right? The lower interest rates are, again, it opens the door in the same way that we were sort of looking for buyers who didn't have to raise debt in 23 because the banks weren't there. Similarly, the buyer pool then widens even further once the rates come down and it's easier to get access to that capital. So definitely expecting multiples will start expanding again. Across the board, and we will see more and more again competition for each company, which is always the biggest driver. So definitely expect that. That being said, though, I mean, even in the past year, we haven't seen interest wane. In fact, because in part 23 was a little bit of a slow year with all the uncertainty in the economy, you had a lot of pent up demand. And private equity groups, who are most frequently the buyers of privately held companies nowadays, are mandated to get their money and use it. So if they don't use the money, if they don't deploy that capital, they have to oftentimes give it back. And so what we did see a lot of was, all right, we're gonna buy this company all equity and we'll finance it with additional debt later on. And so I think that we'll see maybe a bit of that coming back around where the debt is now being done at the same time as the transaction.
Yeah, I agree wholeheartedly. You'll see that across the board. Obviously, M&A in business is a little different than real estate, but they're very similar at the same time.
Yeah, definitely.
And so you're going to see a lot of movement with that. As we wind this down, and obviously we could go for hours, but I always ask every guest this one question, right? This whole podcast is designed to help people take that next step in their journey, wherever they are, right? That's why we have different people come on, from, businesses to people who help businesses to individuals, just simply because we're all on a different path and we're here to help.
Yeah.
What is one piece of advice, idea, concept that you could give someone right now to help them on that next step in their journey?
Yeah. Yeah, I mean, the one that comes to mind I said earlier was time kills deals, and I think that there's something to that even more broadly, which is, you know, taking responsibility for one's own outcomes. It's something that a client said to me once, which is success or failure. When you take that sense of responsibility over both successes and the failures, it makes it so that you're learning those lessons more strongly when things don't work out. And you feel really good when it does, because you know that you really did earn it. And so that one really stuck with me. And again, he's one guy who said time kills deals, and that goes hand in hand with that, which is don't sit around waiting and hoping. You know, if you see something there and it makes sense, you got to take advantage when it's there.
I love that. I really do. And I'm going to tie it into how I end the episodes too is, okay, so now comment, reach out to us, DM us, email us. You have questions, we're here for you. I bring every guest on that I know is a good person who's really here to help you as a person. And so ultimately, the only way to know is comment, like, share. I don't do it for all the clicks. I don't really give a shit about that. It's ultimately because you need the answers. So reach out to us. I'll connect you. We'll all be good and we can take that next step forward. But remember, time kills deals.
That's right. Appreciate it, Soy. Thank you.
Any awards, rankings, or recognition by unaffiliated third parties or publications are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Black Mammoth. Information regarding specific awards, rankings, or recognitions is available on the Black Mammoth website, www.blackmammoth.com. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions and securities, or the rendering of personalized investment advice due to various factors including changing market conditions. The information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up-to-date, Black Mammoth do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature and is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Past performance is not indicative of future results.